So a lot of companies have actually postponed IPOs because they can raise money in the private markets. Why do you think there is so much money available right now to companies like SurveyMonkey?
Well, I think people have seen that there's been a great experience for private growth investing. The investors who've done well in the last 5 years have invested in companies that were still private, and then those companies have eventually either gotten sold or gone public. And there's a lot of money that's flown in there. And you can see this, it's not just private investors. You've seen mutual funds, people like Fidelity and T. Rowe, who have come into private companies. You see hedge funds. You even see sovereign wealth funds going into private companies. So there's a lot more capital available for late stage growth private companies in the technology space, and that's what's causing it. I think what's probably interesting is we are a company that was valued at well over $1 billion a year and a half ago, but decided not to go public. And we've made a conscious decision that we're not going to go public unless we see some real benefits to being public. Like, we don't think, oh, just the next step in the progression is to be public. And I think that's different. It makes us unusual. We raised $800 million. So, it was more than you'd normally raise in an IPO. Part of it was debt. Which is also unusual. So that's not unusual for other companies, but for internet, SaaS, technology, high growth companies, it's very strange. I got a lot of strange questions from people about that. I still get them today.
These companies, these investors have never invested in growth strategies, right?
It's definitely new for a whole bunch of them. I think that the question is what happens when things, hit a bumpy patch, but I think a lot of them have invested in what were growth public companies. And so for them, this is just, these companies are going public a lot later, so they're investing in the same stage. They're just investing in them when they're still private as opposed to public. I mean, nobody goes public today with a $300 million market cap. It just doesn't happen. But that was actually a pretty decent sized public company 10 years ago. So that's sort of, I think, what's happened is that people have postponed it.
You've been in this business for a while. What do you make of the $18 billion valuation for Uber?
Well, look, I don't want to comment on specific companies. I happen to be a very small investor in Uber. I think it's a great company, and Travis and the team have done an incredible job. So I don't really want to comment on particular valuations. I think there's certainly a question people have about our valuations sort of getting out of control. I think the investors are being, quite thoughtful about this. So I don't think the investors are getting carried away. They have a lot of preferences, and they are ahead of a lot of the common shareholders. So they're getting a lot of upside opportunity without much downside risk. And I think that's the difference that people are sort of missing. It's not just like buying a stock. It's with interest rates so low that people can put money to work and say, well, worst case scenario is I get my money back in 5 years. That's not a great thing when interest rates are at 7 or 8%, but at 0, people are willing to sort of say, okay, I think there's some upside here. But if the downside is I only get my money back, it's not the end of the world.
Thank you so much.